So what I want to cover today, setting the scene, that's kind of focusing on key features of a family investment company. I'm then going to run through some typical structures. Obviously, there's so many structures that we can establish, but just a few typical ones as examples. And then I'm going to focus on the tax analysis, then look at the governance, um, focus a little bit on anti-avoidance. Then I'm going to look at the difference between FICs and trusts and end with a case study and then a little bit of a summary at the end there. If I move on to funding a FIC, the top one there is cash. By far the easiest way to fund a family investment company. Whereas there's a limit with trusts. We all know this, but individual has a limit of £325,000. Married couple 650. Anything above that, you're going to get charged to inheritance tax at 20%. We don't have those limits with a family investment company, and that's why they are really attractive vehicles. The 7-year clock obviously applies if there's a gift involved, but you're not on that 7-year clock just by funding the family investment company. Not all clients are sat there just with cash in the bank, though. Some of them are sat there with perhaps an investment portfolio, or they're sat there with properties in their names, and they want to put those assets into the family investment company. And we do this quite a lot. The way that we structure it is that say founder parents have this investment portfolio. They sell the portfolio to the FIC and, document that in a sale agreement. The sale agreement will make the point that there is considerations being left outstanding. This creates a debt owed by the FIC. So FIC owes parents, and then parents can decide to assign the benefit of that FIC to children, to trustees, and then it's for the children or the trustees to choose to subscribe for shares, capitalize that in return for shares if they so wish. We do this as a sale agreement because if you try to gift an asset to a company, it's treated as a chargeable lifetime transfer. So that's why we put that sale element into there. Now, there's obvious tax implications of doing that. The first is capital gains tax. That's something to be managed. You can't get around that with a family investment company. Also be aware of SDLT for properties and stamp duty for shares.